Welcome back, all you tax-savvy real estate investors. In part 6 of our series on taxing and destructuring, we want to talk about creating, increasing, and accelerating the taxable losses from your passive real estate investments. So if you're following along with the series, quickly recall that passive activities in real estate are your buy and hold. Those are your long-term rentals and your short-term rentals, or possibly some other passive investments that you decide to get into. Now, the really cool thing about these passive investments is if done correctly, these will earn you money and they will have real economical cash flow to you, while at the same time providing paper losses, so that on your tax return, you're getting that down to zero or even a loss and not paying tax on this money. So how is this possible? Well, thanks to the magic of depreciation and mortgage interest, you can earn money and have cash flow, but be at a tax loss on your passive investments. Let's dive into it with a quick example. Let's say in this example that you have a long-term rental that you paid $375,000 for. In a given year, this long-term rental earns you $20K of rental income. In addition, you have about $5,000 of rental expenses, and you paid mortgage interest of about $5,000. Now, lastly, you get a depreciation expense on this property of $11,000 from just using the standard depreciation. We'll get into that in a minute as we build out the example more. But if we just work with these numbers, you're at a tax loss of $1,000. So even though that property provided you with a good cash flow, it also appreciated in value while you had the renter paying down the mortgage loan on it, you still get a tax loss from it of $1,000. So what is this magical depreciation expense that everyone talks about? So let's break it down by starting with the basics. When you go purchase something that has a life of over a year, and in general, if it's over $2,500, you are likely going to be required to set that up as a fixed asset rather than deducting it as an expense in the year that you purchase it. Now, each fixed asset that you go purchase is going to have a life that the IRS provides to you. It'll have a life of 5 years, 7 years, 15 years, 27 and a half years, or 39 years. There's some other depreciable lives out there too, but these are the most common. So your residential rental building that you purchase, that has a life of 27 and a half years. The land that's associated with it, that doesn't get depreciated. We'll talk about that as we build out our example more. If you go buy a commercial property or a short-term rental, that has a life of 39 years. If you purchase things such as furniture, carpet, equipment, vehicles, those typically have a depreciable life of 5 years. Now, things such as office furniture, like a desk, that's gonna have a 7-year life. Land improvements, such as a driveway, that's going to have a 15-year life. And building improvements, such as an HVAC system or something of that nature, those are going to have the same life as the building. So if it's a residential, the 27 and a half years. If it's a commercial or a short term, the 39. So using our same example in which you purchased a residential building for $375,000. Let's say that 20% of that is land, and you have to break out the actual value of land by using the county assessor or another option to break out the land. But for these purposes, let's just say $75,000 was land. We're not going to get to depreciate that. That'll go on your fixed asset schedule, and you won't get the benefit of that until you sell the property. That leaves $300,000 that's associated with the actual building. It's a residential rental, so it's 27 and a half years. If we take the $300,000 divided by the 27 and a half years, that's about $11,000 a year in depreciation expense. So if you remember from our first example, that's where that $11,000 in depreciation expense comes from that created the $1,000 loss for you. So going to the next step, let's talk about bonus depreciation. So what bonus depreciation is, if you remember, the government loves to incentivize taxpayers to do things that will help the economy. Well, one of these incentives that's been around for over 2 decades now is called bonus depreciation. What this means is that when you go purchase one of these fixed assets, one of these purchases that has over a 1-year life and it's over the de minimis $2,500 purchase limit, and you set that up, instead of dividing it over 5 years or 7 years or 15 years, the government says you can take bonus depreciation on it, which right now in 2024, it's at 60%, and in 2025, it goes to 40%. So if you go buy carpet that's $10,000, normally you'd have to set that up and divide it over 5 years and take it as $2,000 a year in depreciation expense. But using bonus depreciation, if that carpet was purchased in 2024, you can take 60% of it right away. Let's say it was purchased on January 1st, 2024. Take 60% and we're at $6,000. Then the $4,000 that's left, we divide that over 5 years. So in year 1, you're gonna get a depreciation expense of $6,800 instead of $2,000. Now this works for most fixed assets, but what it doesn't work for is the building itself. They will not allow you to take the 27.5-year building or the building improvements or the 39-year commercial or short-term building and take bonus depreciation on that. It is required to be depreciated on a straight line basis over 27.5 years or 39 years. So enter cost segregation studies. We're not going to dive into those here, but we'll do so in a future video and possibly even its own short series. Just know that if you have a residential or a commercial or a short-term building and the value that you've bought it for and have put into it is worth enough, it could make sense to use a cost segregation study in which a portion of the building is broken out into 5-year, 7-year, and 15-year property, and you can utilize bonus depreciation to reduce your taxes and accelerate that tax savings. One other item I want to make note of, which we'll get into in a future video, is something called depreciation recapture. So for any property or investment or equipment that you're getting, you need to also be aware of what you're planning to do with that. Because if you buy it in 1 year and take the full depreciation and sell it in the next year, you're going to just have to pay back the tax through depreciation recapture, and the hit on that may end up being larger than just never have taken the bonus depreciation at all. So what we want you to take away from this video is that by properly timing your rental income and expenses, by shifting expenses the same as you might do so in your active real estate ventures, which we talked about in the last video, and then ultimately by purchasing and timing fixed asset purchases and calculating and utilizing depreciation properly, you can create and increase losses from your real estate passive investments. The trick now is how you get those real estate passive losses to offset your active income. That's the real exciting stuff and what we're going to dive into in the next video, so be sure to click on that next.